Good morning, everybody, and welcome to the latest in the IMAP webinar series. One of the things we learned from COVID is that the advantages of virtual mean that you can take a theme. Today's theme is the tools we use in portfolio management, and you can actually drill down to it in considerable depth. And so today is the first in a series of 3 webinars which examine the roles of technology in portfolio management, administration, trading, reporting, performance reporting. Today, the whole series is going to be moderated by Nancy Ewan of SS&C. But before I hand over to Nancy, let me just say a little about other events which IMAP has coming up. Next month, we'll be running a webinar series on an issue which is absolutely central to the thinking of many advice businesses: how to build a client base of wholesale and not-for-profit clients. That webinar series will be presented by almost completely by practitioners, mostly CEOs of very successful advice businesses who've based a substantial portion of their practice on these 2 really unique types of client. In June, a webinar series on asset allocation, but before then, we'll be running the next of our live conference series, the Advisor Roadshow, in Brisbane, Sydney and Melbourne, where we'll be focusing, as we do in the Advisor Roadshow series, on the business of advice, on how to run effective advice practices, how to make strategic decisions about advice businesses, and the role that managed accounts play in those. And then in August, the Managed Account Awards. The awards entries will be open this week, and I'd encourage you all to participate. Through today's webinar series, if you have a question, down the bottom of the screen, you'll see a Q&A button. Type that up. The question will appear for the moderators and the presenters. So today's session is on portfolio construction, management, and research tools. It's moderated by Nancy Ewan, who's product manager for Global Wealth Platform for SS&C Technologies. She joined SS&C in 2012 and has worked here in Sydney and in Canada. Nancy has a background in operations, investment services and technology, as a Master of Applied Finance, as well as a degree in commerce. Now, SS&C, I've been a client of SS&C's originally in 2004, as it turns out, one of the very early clients of the Global Wealth Platform. SS&C is NASDAQ listed, 22,000 employees worldwide, and SS&C Technology runs over $41 trillion of assets. So even in Australian super terms, a substantial pool of assets run on their technology. The Global Wealth Platform, as the sponsor for this week's webinar series, is SS&C's cloud-based software supporting wealth management. And as I know, wealth management firms, platforms, managed account providers, brokers, and banks. Has full Australian taxation capability and supports a multi-account structure, multi-currency. In many ways, it's representative of the sorts of capabilities which this whole week's webinar series is going to enable us to talk about. So now it's my pleasure to hand over to Nancy Ewan, moderator for today and the rest of this week. Nancy, over to you.
Thank you very much, Toby. Hi, everyone. Welcome to IMAP's 3-part webinar series on the topic of tools we manage portfolios. So as Toby has introduced myself, I'm the moderator, Nancy Ewan, product manager of S&C Technologies GWP. So with advancing technology leading to lower costs, institutional grade portfolio construction and research tools are being increasingly used in advice practices. To spearhead our 3-part webinar series today, Our topic is portfolio construction, management and research tools and how to build portfolios. The key concepts we would like you to take away from today's session is how the tools we use or have developed are aligned with our investment philosophy, how they assist in ensuring the portfolio is aligned to those characteristics, and what outputs from these are accessible to advisors or clients. So we are very lucky and excited today to have a mixture of experts within our panelists who have different outlooks on portfolio construction, management and research tools. They will give you an insight into the different investment philosophies in practice, the tools used and the value to your clients. So with warm welcome, I'd like to introduce you to our panelists for today. Our first presenter is Michael Fury, the founder of Delta Research and Advisory since 2012. Michael has been working in the financial services and investment industry for the last 22 years and currently runs his very own quantitative research and consulting business. Michael will be presenting to you the Delta factors, how Delta's investment philosophies, investment performance behavior impacts on how a basic portfolio is constructed. Our second panelist is Stephen Tang, who is head of consulting from Zenith Investment Partners. He has held various roles within the company for the last 15 years and is CFA and CAIA qualified. Stephen will be dipping into the external and internal tools available at Zenith for portfolio construction. And finally, our last panelist for today is David Leon, advisor and founder of Stellan Capital. He has held multiple director and executive roles at Goldman Sachs, JB Ware and Morgan Stanley. As an advisor, David will be providing his take on applying macro themes to construct a portfolio with his clients. And finally, to conclude our webinar, we will have a Q&A session with the panelists. So feel free to send questions throughout the session by clicking the Q&A icon at the bottom of the screen. And over to you, Michael, as our first panelist.
Thanks very much, Nancy. So also I should thank Toby and IMAC for the opportunity to talk today on something that I am very, very passionate about. So the tools we use to manage portfolios, and I'm sure everyone does use multiple tools, as do we. But we're going to be focusing on one primary tool, but that is Delta factors that Nancy mentioned. But before we get into that, just a little bit of background to begin with. So when it comes to, I guess, setting our own investment philosophy or set of beliefs, I guess, firstly, we're going to have some sort of opinion as to how efficient markets may be. So we've got some sort of decision around active or passive, and which markets do we believe are more efficient than others. Across the, I guess, financial advice industry primarily, we typically have an asset allocation approach where the asset allocation is the major driver of risk. It doesn't have to be. And so, we may have a decision around, do we believe it's worthwhile shifting away from that asset allocation risk and taking on more concentrated or alpha risks? And then I guess the decision we may be making when it comes to portfolios or our beliefs, we may have beliefs around particular styles or smart betas or factors. Which of those do we believe work? Value versus growth, high yield versus credit, etc. So there's some of the beliefs that we typically have. And so when we're building a portfolio, we want to make sure that the portfolios reflect those beliefs. And it's the tools that we have, I hope, will go towards, the tools that we have will help us determine whether those beliefs are reflected in the portfolio. So basic portfolio construction, you can see the slide there. So, the first step when building a multi-asset, multi-manager portfolio is that asset allocation decision. That asset allocation decision is just primarily a market or a beta decision. The next layer down, we end up choosing investments to reflect that asset allocation. That's when we may introduce that alpha or non-market risk. If we can go to the next slide, that's when problems can occur. So we need the right tools to ensure that our beliefs are reflected. And then when we do shift away from that asset class risk towards some other risks, that we're capturing the risks that we want. And that's probably the essence of the tool that we're going to look at today. So we'll go on to the next slide. So quickly about delta factors, what it is. It's an analytic system it really is a graphical interface. There's no need to understand any fancy mathematics or anything like that. It is based on some award-winning research by William Sharpe, the old Nobel Prize winner, his return-based style analysis, and a very famous study called the determinants of portfolio performance. Now, a lot of us have heard about this, where we hear that more than 90% of the portfolio variability comes from the asset allocation decision. That's from this second study. It doesn't have to be, but that's what a lot of us believe. So delta factors is really primarily about understanding investment performance behavior. And it looks at a number of factor-based or systematic-based risks. And through that, we can see what the exposure to asset class risks, style risks are, and also whether a particular strategy is adding value as well. Ultimately, we want to answer the question is, does the investment do what the investment manager says it does? Or does it meet our expectations as well and capture those risks we want it to? So I'm going to go through a few examples now, and I'm starting off with a simple one. I know you're looking at a lot of charts here and there's a lot of colors there. But what we're doing with this particular, what we're looking at with this particular chart is the left chart sort of pretty much says it all. Okay, so the left-hand chart is actually a breakdown of the portfolio risk into, if you can't read it, there's about 7 different components of risk we're looking at with delta factors. And there's only one color coming through, and that's blue. That is the market. So this particular strategy is 100%, or pretty close to it. It's about 99.95% market risk. So it doesn't take Einstein to work out that it is a pure index fund. Okay, and so I haven't got the names there on purpose, but this is an index fund. The benchmark, which you may or may not be able to read on the top left-hand side, it's MSCI World. So it's a benchmark, it's an index fund that reflects the MSCI World. Now, the bottom right chart is the beta to that particular benchmark. And you can see there, it's very, very consistently 1. So this particular fund, beta 1, 100% risk, is MSCI World. This is an index fund that hopefully is reflecting the index that we expected it to reflect. So a very, very straightforward piece of analysis that is determining that the behavior of this fund is exactly an index fund. So we'll go on to the next slide. A little bit different. We've got a couple of extra colors here, okay? And I probably should add, this is all time series based, just like, and we can see how the exposures to different risks change through time, okay? So again, the risk profile on the left, we can see it's around 90% blue. So 90% of the risk comes from the market. And that's pretty standard for a lot of active strategies. So the remaining 10% of the risk is actually a couple of different styles, which we can see what they are on the right-hand side. So one of them is purple, which is value minus growth. If you can see the purple chart on the right, that's negative, which means the minus growth. So that's because it's consistently negative, we can safe to say this is a growth style. The yellow has got an average beta. It's very, very consistent. That's the quality factor, which is 0.989, so close enough to 1. And so it's actually a quality factor with a positive beta. So it's the quality sort of style, which is 100% growth and quality in terms of that non-market risk. So if this was an active strategy, and it is an active strategy, but it was an active manager, you'd probably be a little bit disappointed because 100% of that non-market risk just so happens to be reflected by growth and quality. What it actually is a smart beta strategy and it just so happens to be a smart beta strategy that reflects the quality part of the MSCI World Index. Okay, so it's an ETF, I'm sure many of you may be familiar with, but it's safe to say that this smart beta strategy, the history of the performance is pretty much what you would expect. It's quality growth. Now, some of you may say, hang on, this is a quality index. How does growth come through? Well, the reality of the quality smart beta factor is that it is typically correlated with growth, and that's why growth comes through as well. So that's something that this particular system can tell you about this particular index. So now we'll move on to a pure active strategy. Now we've got a few other factors coming through and a few more colors on the left. You can see that the market's still the dominant factor. It's still the dominant risk of the portfolio, and this is very typical of what you would and should expect to see with a long-only strategy. You can see the market's responsible for between 70 and 90% of the risk, approaching that 90% figure from Brinton, Hood and B. Bauer. But it's pretty much what we would expect. So some of the other colors coming through, we can see probably purple coming through most of all. And if we look on the bottom right, we can see that purple chart is mostly negative, suggesting it is also a growth strategy, just like that smart beta strategy. And that is actually the case. This particular active strategy is growth with its style. But there's a second color that comes through quite significantly, and that's the green. The green is what this system calls idiosyncratic risk. This is the risk that we pay the big bucks to active managers for. And you can see it's around 10% of the portfolio risk, which, believe it or not, that's quite a significant amount. So this is, I wouldn't say a benchmark unaware strategy, but it's pretty close. It's actually quite different from the benchmark. So we want to assess whether this strategy is adding value. So if we look on the chart on the right, the green charts, if we can go back one quickly, we can see that certainly in recent years, that green chart on the right has been really, really positive. So this is an active strategy that's certainly added value, but before that, it was a bit up and down. On average, it's added value. So we'll quickly go on to the next one. This is a strategy that has no blue or very little blue whatsoever, which means it's got nothing to do with the market, with the MSCI World Index. This happens to be a hedge fund. It's a global macro type strategy. And we can see that there's some smart beta strategies coming through. We can see minimum volatility, negative. So it's sort of high volatility stuff. These are all market neutral factors. We've got orange, momentum. Maybe it's a managed futures strategy. I don't know. Well, I do know it's global macro, but maybe there is some managed futures part of it. And then there's negative red. The red is size. So that's large caps coming through, but majority of it's green. That's a pure alpha. That's non-market risk. It's very, very different from MSCI World. So in portfolio construction, this strategy has little correlation to no correlation with the market or the global equities whatsoever. So this little system helps me define the risks that I want, the risks I don't want, and whether they, how they're going to blend together as well. So I'll just move quickly on to the next slide, which is really, summing what we're up. When we're building a portfolio, what is the role of each investment that we have? Do they reflect my philosophy and beliefs and their role that they have? Are they true to label? Are they adding value? What's the risk-adjusted value? And are there any unexpected risks that may have come through that we weren't aware of? These are all potential red flags or questions for the managers, but these systems certainly help us identify those red flags or answer some of those questions as well. So I'll pass on to Stephen now to Nancy for the next session. Thank you.
Thank you, Michael. Yep, that's right. We'll pass on to Stephen now to present Zenith Investment Partners strategies. Thank you.
All right, thanks, Nancy, and thanks to Toby for having me today. So today I'm going to speak through two tools that we actually use in the consulting division of Zenith Investment Partners. One of them is an external tool that we've sort of purchased, and the other is an internal tool that we've developed. So the first one I'm going to talk through today is an external tool. So the external tool, sorry, next slide. MSCI Barra, but actually before I do that, it's good to set up some context before we sort of talk about the tools. And I suppose, relating it back to the topic of this this webinar is really sort of what are the tools that you use that help you adhere to your investment beliefs and the way you construct portfolios. So I think the context here is important for what we do. So just in terms of what we do, we try to design portfolios that deliver on their objectives, but do so with a lower volatility and drawdown. We aim to be well diversified and reasonably style neutral. And as a research house, we're fairly big believers in active management. Obviously, it's important that you pay for active management, and that's one of the tools we'll go through today, is actually looking at sort of how much active management there is in terms of these strategies. The other thing to recognise, and today we're really focused on tools, but it is important to recognise that portfolio construction isn't pure science. You can have all these tools and they're a great input into your portfolio construction, but there's a qualitative element that you can't get away with in portfolio construction. And that's something we're not going to cover today. But for instance, the ratings we use from our research team are very much qualitative in nature. They're a forward view of the quality of that rating of that manager. So that's something you can't take into account. And it's important to recognise as well, the output of MSCI BarraOne that we're just about to go through are very quantitative nature, but you need to recognise that sometimes, those tools, the output, you need to read them with some skepticism, because sometimes it doesn't quite work out the way you think it will. So just touching on MSCI BarraOne now, in terms of why we went down this path. MSCI BarraOne is really an institutional risk management tool. It's really come down into sort of our space. We're, from my understanding, the first in the wholesale space to use this, and it really allows us to sort of look at a portfolio on a holistic basis. So that's something that is really quite lacking prior. It's really quite hard to actually get full look through of a portfolio and understand sort of where you're running risks, and this tool allows us to do that. So it uses a combination of holdings based. So for all equity holdings, we actually collect all equity holdings from every manager that's in our portfolio and that is rated. And for the other asset classes, fixed income and alternatives, it uses a bit of characteristics and regression to actually do it. So there's a bit of crossover with what Michael was talking earlier before, but some of it is, a large part of it is holding based. So what you see here in this chart, on the left-hand chart, is a snapshot in time, and the one on the right is through time. And it's important that you run both of these, because obviously things can change. And so what you can see here, and this is run on our elite blends, and I'll sort of touch on that in a moment, and it's relative to diversified benchmarks. So what are we trying to get out of this? Remembering what I said before, we really want to run a fairly style neutral portfolio. So we want to make sure at a holistic basis, we're running those portfolios at a fairly style neutral basis. What you can see here on the right and the left is the fact that we run a fairly significant size bias, and that's intentional. We know that, so that's not a surprise to us. The other one that you'll see on the right is really through time, you're running quite a high vol, and that might be a bit surprising because, again, if you think about what I premised this conversation on, is that we try to deliver with a lower volatility. What that really is saying is that we're running a more concentrated portfolio, and therefore our returns are a lot different to the benchmark. That's what we want. So that's something that we really do want to do. You really can't see here that there's also bands within this that you really don't, that they're not significant. It's a bit lost in the right-hand chart, but there's an insignificant range where, effectively you're not running the risk. So the real key ones that you can see there are the size and the volatility. And the yield one is actually there as well, but the yield is related to the size bias that we do run. It's important to say that we do run these against diversified benchmarks, and that's what you see here today. But how scalability helps us is actually we can run this against every client portfolio against what we have as what we say is our core portfolios or our preferred portfolios. And they are the purest expression of what we sort of want our clients to sort of get. So that's, in terms of style factor exposure, in terms of active management, in terms of fund selection, and we can run every client portfolio against that preferred portfolio and see how they're positioned versus that preferred portfolio, and see whether or not their outcomes are different to what we would expect. And that's important for the scalability. Running a lot of managed accounts, that becomes a very important point. Just next slide. So this one is an active risk decomposition. So Michael spoke about looking at risk and decomposing it. So this is really sort of going at a holistic portfolio basis. So this is not looking at individual funds. This is looking at the actual overall portfolio and the active risk. So getting rid of the market-related risk you can see on the left there, it breaks it down into sort of fully all the different factors and what you're sort of running it against. Now, what you really want, and what Michael alluded to before, is that selection risk, that idiosyncratic risk. You want to be running a high amount of idiosyncratic risk in your portfolio. So you want that active risk to really be driven by that idiosyncratic risk. And it's important to realize that there are factors. So that's what you see on the right-hand side. So that's, again, a through time analysis. And it's looking at the fact that, we have common factors. So that's the value, style, quality, growth sort of factors that are driving some of that return, and that's to be expected. And the non-factor risk. But you can see there, that's the dominant driver of our returns, and that's what we want from our active risk exposure. Of course, you've got some currency risk as well, and that's what you take versus the benchmark. So that's that's making sure that we're actually paying for that active management and we're getting it. And when we combine the portfolios, that we don't actually end up with an index-like exposure. So that's important, and that's why we run these analysis, to ensure that we're not running an index-like exposure. And often, we will get client feedback that we have quite a lot of funds and allocations. But we're making sure that those allocations result in a high active factor risk. Next slide. So the other one that is important, and this is becoming increasingly important for our clients, as well as the government's frameworks around managed accounts are becoming more onerous, and they're asking us, how would your portfolios perform in certain scenarios? Well, MSCI BarraOne allows us to do that full look through the portfolio and actually say, okay, in given scenarios, and these are set scenarios, you can actually tailor these scenarios to whatever you want, but these are the tailored ones. And you can see how you'd perform relative to the benchmark. And again, relating back to what I said originally, we're trying to design portfolios with lower drawdowns. So we want to make sure that, in these type of scenarios, and again, remembering that, historical is great, but, you're going to need a grain of salt. But you need to have a look and see, okay, so the one there that probably stands out is that Nikkei stock price correction, and you can drill down and see why that is. And if you looked at the portfolios, obviously we have a weighting away from the US and more to the Asian market, and that was why, in that scenario, thinking back to that period, is why our portfolios underperform there. It's a very unique situation. So that's the stress testing that we do across all our client portfolios. So now I'm just going to turn to the internal tool that we use. So that's going through the external. We call it Portfolio Admin. So Portfolio Admin is an old tool. It's not really a real name. It's just what we use to design portfolios with internally. And it allows us to construct the portfolios and have a look at the full characteristics of the portfolios. So what I've pulled out here is an Australian equities or shares output from this system. And this is really allowing us to have the full look through again and look at through key risk characteristics. And you can see there, there's a few highlighted sections, but the reason why I pulled this out is the Australian shares part out is because remembering we're running that small cap bias, and I wanted to emphasize that this is really where it comes through. The small cap bias is really through our Australian shares sleeve. But you can see there the risk metrics. Standard deviation is high at the overall at that sleeve level. The tracking level is high, so this is all ex post, so it's also after the fact. And MSCI is ex ante or before the fact, so it's anticipating how much you will do. So all this is complementary in terms of analysis. But what we want to make sure that we're not too surprised by the fact that we're running more risk in the Australian shares sleeve, but we designed the portfolio overall, and which you can't see in some of the output here, to be less risk and lower drawdown and lower volatility. So even though we're running more risk in this sleeve, we know it, but when we combine it into a portfolio, you end up with a portfolio that's actually running a lot less risk. The active share part is what you didn't see in MSCI Barra. Is also important that we try and run a lot of active share. So we want to be different from the benchmark. And we want to look at so what you can see secondly is the sector positioning. And what you want to see there is ensuring that the actual sector positioning and how you're sort of different from the underlying benchmark. So if we now move on to sort of the new tool we're building, which is what we call Mosaic. So what we had before is a tool that was really in the back end, and we were sort of creating that. Mosaic is our new online tool that we're building right now, and we're transferring all of that IP that we have in the portfolio admin system into this online tool. So what you see here is a snapshot of that tool, and the donut on the upper left, is really sort of the whole portfolio. And what you can see here is what I've done is, and this mosaic tool is fully interactive. What you can do is click into the Australian share sleeve, and you can see the sector exposures or regional exposure. Obviously in Australia, it's going to be fairly Australian, but I wanted to keep it fairly consistent. Now, Mosaic is a fully interactive tool, as I said, so it allows us to go and see all the things that you saw before in a portfolio admin tool, but in an interactive feature and on the fly. So our clients and us, we can build portfolios sort of live, and we can see these outputs, and we can see, how we're positioned relative to all the, the sectors and the regions. And we can see sort of the top active stock weights and positioning versus benchmarks for duration. So really, this tool is going to supplant everything that we have in portfolio admin, and it's actually going to be a tool that we roll out to clients. So remembering, part of this presentation is about what we are rolling out to clients. So this is some client functionality will be here, and there'll be some additional functionality we have in consulting. But effectively, that will be the tool that will allow our clients to see everything as well. So it's important, actually, I didn't say that MSCI BarraOne is really a tool that we use internally and not externally. So this will be an internal and external tool and allow our clients to really get that overview that they want. Really, so that's really the two tools that we use, and just remembering that these tools are inputs into our system, not the fully, even though they're great output, we treat, there's a qualitative element of portfolio construction you can't get away from. That's really it, Nancy.
Thank you, Stephen. So before I pass on to the next panelist, David, just want to remind everyone that don't be afraid to click on the Q&A and ask any questions if you have any, and we'll be monitoring it and we'll be discussing it in the Q&A at the end of the session. So just over to you, David Leon from Stellan Capital.
Thank you, Nancy, and thank you, Toby, for having me along. And Stephen, Michael, nice work. My segment for the participants is actually broken up into two parts. So at Stellan Capital, as we probably discussed amongst our group before this call, probably a little bit more at the coalface. So we tend to deal more with the families that have originated this wealth. Quite often, a number of the fund managers on this call might be liaising with someone like myself. So we thought we'd break up my segment into how we communicate risk mitigation with our clients, how we keep them invested, and then go into some of the factors that I think are driving the industry and some of the tools we might be using there. So we'll just hop on to the next slide. So from our perspective, one of the things that is probably a little bit different for us versus a number of the fiduciaries on the call is that we don't always have a discretionary mandate. So quite often we have to get buy-in from our investors to stay the course. So effectively help them to not buy high and sell low and have emotional knee-jerk reactions to the market. So when we approach, if you will, risk mitigation, we also can't make the assumption that all of our investors have the amount of tools that you would typically find at a board level. And so we quickly run them through, if we will, the three dimensions of portfolio construction. So asset allocation, as Michael and Stephen have alluded to, is one of the most significant drivers of risk mitigation. For us, this also plays into the risk profiling for the client. So we'll deep dive into other factors. So for example, what is the drawdown requirements? How long does the capital need to last? Clearly volatility is very important, but we also have to take into consideration the tax implications of any buying or selling. And then, as I'll hit later on in this presentation, their values, the ESG factors. When we get to the y-axis, we do talk about, of course, the construction itself. And again, not always having discretionary mandates. We don't always have perfect control over whether or not the portfolio is perfectly diversified. So utilizing those 20, 30, or 40 stock portfolios, quite often for us, we will inherit portfolios that have huge concentrations, 1, 2, or 3 stocks. And the client might come back to us and say, hey, I've got my 30 stocks. What are you talking about? But I'm like, yeah, but 15% of it's in one individual position. So we have to then show them how that volatility is introduced into the portfolio. And then one of the things I think that's really important for investors, particularly in Australia, is that third dimension, what we call the Z-axis or the Z-axis. And here it's about looking at it from the perspective of not only regional diversification, but also that currency diversification. Next slide, please. Now, one of the things that we do at Stellan, not all of our clients have all the technical nomenclature regarding Sharpe ratios and of course, the diversification factors. So what we do is we try and get emotional buy-in. And so at Stellan, and I've seen a number of different variations of this particular approach, but the idea is to get them to buy into what we call inevitable thematics. So I do joke that it doesn't matter what Trump tweets or Lil Kim drops or Putin invades, these things will happen. And so when we do get these emotional roller coasters, like we've had over the last few weeks in the markets, clients feel comforted that the particular theme that they have bought into will still persist and be fine on the other side of this market volatility. Of these 5 thematics, sometimes I also refer to them as investment properties. We've put one of them up on the slide deck, aging demographics. So I think most of our clients do fall between that 50 and 75 range. And so this resonates with them. They're of course in G10 economies. So they get, and they can see the aging demographics around them. And stats like this, where you kind of bring in that thematic of saying, over 3.5 million people projected to be over the age of 100 by 2050. People go, yep, no. And then we talk about how expensive it is to age. Close to 75% of our medical bills might be spent in the last 5 years of our life, and that's with a life expectancy of 86. So what happens when you're over 100? And so then we look to find themes or stocks that resonate with that particular theme. Now, with that being said, we still have all the same requirements at our level when constructing these portfolios in regards to the due diligence around, ROE metrics or their balance sheet strength. And any other criteria that you might focus on. So quality is, of course, utmost of importance to us also. However, to our end client, quite often there's a sniff test, which is, do I recognize the name? Next slide, please. So what we thought we'd do in part 2 is break down kind of how the marketplace around us is changing. I was on another panel that had one of the largest online trading platforms in Australia, and the growth that they're seeing in their space is just J-curve. It's incredible. And what that's done is has put more and more emphasis on this bespoke advice and what we're doing in that space. Now, some interesting in regards to families, stats, 2% of the population is considered high net worth, which is that 1 million outside of their home, because everyone's a millionaire in Australia if they own a home. But what's really interesting is that top 10% controls almost half the wealth in Australia. Now, in the United States, those numbers get even more skewed, where 10% of the population has 90% or more wealth than 90%. So it is interesting to see kind of where that concentration of wealth is going. Next slide, please. And how that's driving the behavior of these investors, these high net worth investors. So at present, almost 3/4 of them are getting advice from somewhere. However, not that majority isn't a massive majority in regards to feeling that they haven't still gotten all the advice that they need. So they still have unmet needs when it comes to that advice. What's interesting is that, and this is important for the fund managers on the call, is that they're looking quite aggressively for a wider range of investment opportunities. So they're wanting a second opinion. And of course, its technical expertise around the advisor continues to grow, but the biggest change that we're seeing year on year is wanting more diversification and more offerings within their portfolio, which bodes well for those investment managers who become specialists. Next slide, please. What's interesting also is, how do we tackle generational differences? So what's very interesting from what we've seen in the last year, no less the last few years, is this huge growth in online investors, which of course is stealing market share from the active fund managers. So we've crossed over 1 million online investors. That of course competes directly with the fund managers, the SMAs, the IMAs. So you see a lot more of that DIY, a lot more of that focus towards index investing, which of course has been happening in the US for quite some time. What's interesting, of course, is also how do we tap into that next generation? I've read a number of studies that say, you know, between 60 to 85% of relationships with an advisor do not bridge to the next generation, and that relationship is lost when the patriarch or matriarch passes on. So we have to be quite focused on not only the children, but we also have to be focused on our clients' parents. Next slide, please. One of the thematics that we have seen at the coalface growing exponentially is the concept of impact investing, or also known as ESG. So as far as tools that we use, our friends at Refinitiv have some fancy whiz-bang analytics deep dive, which allows me as an investment advisor to deep dive into an individual stock. This has been very popular with our clients. Interestingly, you know, 20 years ago, ESG was probably one of these things that was kind of talked about, but it was more around the edges, where now, you know, 20 to 40% of investment decisions that we are seeing in regards to what we can see online for online investors, the factors for buying and selling, between 20 and 40% of those decisions are being driven by ESG factors. So we can't ignore this. This has become very important. And I can say my own personal experience, a number of clients, particularly those who are under 45, who have significant wealth, they are coming to us and asking us to rebuild their portfolios in a way that is better for the future and for the environment and for social imperatives. Next slide, please. So finally, as far as these tools, I think that one of the things that I wanted to emphasize in our segment is notwithstanding all the tools behind the scenes that we go into constructing portfolios, we are now seeing greater emphasis on some of the intangibles in regards to that client and advisor relationship. They are not just looking for returns from us, they're looking for a number of different types of communication tools, whether that be apps, whether that be blogs, newsletters. They want this actually, amazingly, this Zoom interface has increased significantly for us. I'd say 1 to 2% of our clients had heard of Zoom prior to COVID. Now 65% of our clients actually prefer this interface. It's easier for them, they get more from us. And then finally, I think the idea also around fund managers is how you engage some of the other advisors in our clients' lives, that deep relationship with the other key role players who are sitting there watching those milestones are very important in regards to that kind of maintaining, if you will, your link to that client. So some of the stuff we're seeing on our side, individually managed accounts have become almost a go-to. This is where they get their bespoke, if you will, easy implementation, but they still have that ownership. They want to see, of course, sophisticated analytics around that, but they don't want to necessarily be involved in it. Wealth coaching is very important. Wealth planning, which is also known as, traditionally known as financial planning, and of course, legacy planning, how we get this wealth to the next generation. So anyways, these are some of the, if you will, experiences that I'm seeing at the coalface with families, but looking forward to getting into the Q&A and passing it back to Nancy. And I can see already questions coming through. Thanks for your time.
Thank you, David. And thank you, Michael and Stephen, for your insight today. So we did receive a number of questions throughout the session, so we'll have time to discuss that. Do we have the Q&A slide up? That's okay. So firstly, how do you ensure that a portfolio you have developed to meet certain parameters remains aligned to those parameters? So that's a more generic question for all three panelists. So I'll start with Michael first.
Well, how do I ensure it? Well, the delta factor system is a time series based system, so I'll just focus on that particular one. It's not the only tool I use of course, but where it is a monitoring tool. So as you know, time goes by, it's updated on a regular basis, and then we can see how the betas change, how the risk profile of the fund changes as so it doubles as a monitoring tool as well. So if something, if we've got a growth manager and all of a sudden it's sort of value, it's a red flag for us to then say, okay, or ask the question of the manager, what's going on? Why has this changed? Why has the beta changed, or what have you? Have you gone increase the cash or something else? So for that particular tool specifically, that's part of the monitoring process.
Okay, thanks, Michael. What about you, Stephen?
Yeah, Nancy, so you saw that we run the analysis through time. So we're running every quarter, we're running all our client portfolios through MSCI BarraOne and actually having a look at the style output and all the factor outputs, and including the idiosyncratic. So we're monitoring that on a regular basis in terms of if anything there that we wouldn't expect. And clearly the things do change over time, so they're not static. So even if you run it over time, you can see some changes through time, with even now making any portfolio changes, it's the underlying manager that's making the changes. Right. So we just wanted to make sure that they aren't excessive or something that we we're surprised by outside of that. Yeah, so that's how that tool helps us really.
Mm-hmm. Okay, thank you. What about you, David?
From our perspective, it's very much a focus of monitoring the portfolio against a number of predefined benchmarks. The sensitivity to those benchmarks is critical for us to whether or not we are deviating from our strategy. Because we're thematically focused, quite often there aren't really a lot of reasons to pivot. So most of the changes that take place within our portfolio, probably from a fundamental perspective, something has changed within a company itself. I do like to joke that there's only 20 or 30 seats at the table. And so when I do bring something in, usually something has to come out. So I would say that, we're probably more fundamentally driven when it comes to short-term changes, which is pretty easy to see when, especially with some of our deep dive analytics through Refinitiv.
Okay, thank you. So there are some kind of like monitoring tools for all three panelists today. So I'm just going to move on to the next question. Unless Michael, Stephen, or David, you have anything else to add? No? No. So specifically for Michael, there is a question here. Given that many funds have short-term return histories, how do you get comfort in the statistical significance of the exposures betas to factors?
Yeah, so with respect to the tool that I showed, if it's a short-term history, I don't use that whatsoever. If you're thinking about allocating capital to a brand new strategy, well, if there is no track record, or long track record, then your allocation to that strategy is probably for other reasons that aren't necessarily quantitative based. So what the tool does rely on is a decent track record. So it has been designed so it is a time series based, so you can see consistent, risk exposures or proportional risks. You can see consistency and you can see changes through time, which we've purposely excluded the statistical significance. Like as you can see, it's pretty colourful. There's a lot going on. So the trend matters as well. If we're going statistical significance with time series, we often need track records that are outrageously long and impossible. So we're looking for trends through the system. Otherwise, we're relying on other tools like what Stephen spoke to, holdings-based stuff to make sure that there's a reflection of the various factors that we're looking for. If that's right. But for my system, it's time series does rely on long track record. It's rolling 36 months, so that's one data point is just 3 years.
Right. Okay. Thank you. So even if there is a short-term history, as the question has stated, I guess you'll use other tools as well.
Correct. Absolutely. Yep. Yeah.
Okay. And for Stephen, how are you finding market and liquidity testing tools for fixed income in light of SPS 530?
That's a very specific question, to be honest, Nancy, in terms of the APRA guideline. But fixed income is a very challenging one to provide that liquidity analysis, to be frank. We don't collect, as I said in the presentation, we don't collect the underlying holdings for fixed income. We actually collect characteristics for those. So we actually do rely on the managers for that fixed income liquidity analysis still. Even if we didn't, though, it would be very challenging to provide sort of liquidity. And we get asked this by the governance people all the time. Like in fixed income, what is your measure of sort of liquidity? I mean, you can sell like fixed income at some price. You might not like the bid that you get, but you can sell it. And so it's a bit of a tough one to answer, even when we get asked by the governance, the platform governance teams. It's a very challenging one to answer. But we do rely on the underlying managers to provide us liquidity analysis, and they generally provide bands like, I can sell this security within 30 days, within 7 days. But it's, again, you could sell a whole portfolio, but you just wouldn't like the price that you got.
Right.
So,
Fair enough. All right, fair enough. So I'm just going to move on to another question that we have. So this is a rather generic question, so it applies to all three panelists. Tools are only as good as the data that populates them. How do you ensure the accuracy of the data you use? So I'll just go in reverse and start with David.
I love it. You stuck me with the hard one. Look, I think the reality is that a lot for what we do, a lot of our portfolio construction is direct. And so we are very much focused on the underlying of what companies are reporting to us. I do have certain biases in regards to certain markets that I like to avoid, simply because I don't trust the regulatory framework that keeps a lot of these people honest. I do, of course, focus on the information that's coming through, not only from the company, but from consensus and then individual research. So when it comes to the analytics, we have a number of different tools that we like to use. There is inconsistency amongst them. I think that you have to question everything. But I think this question, so I'm going to handball this over to Michael and Stephen, because I think they love this stuff a bit more than I do.
All right, Stephen, how about yourself?
Yes, I mean, we use a lot of data providers as well as actually collect our own data. So clearly where we use an external data provider, we're reliant on them to provide us accurate data. Having said that, we do check some of the data that's provided to us. So, performance data, we collect all our own performance data still, and we validate that against sort of what we get from an external provider to make sure that it is accurate and that we're happy with the output. The other aspect that we do collect ourselves is all the holdings of the equity managers. So we collect that in-house, and so that is actually validated every quarter. We sort of run it against some checks to make sure that there's not negative cash. So you can't have negative cash. There's some overall checks that we make, and if there are any substantial changes through time, managers can make that. But that's also a flag that for us that we go and check and make sure that that is actually accurate. So that's really the two. So relying on actually external providers, and these are well-known providers like MSCI, that you would hope have pretty good data processes. Otherwise, they wouldn't be in business. So I wouldn't think. Yeah.
All right. What about you, Michael?
Yeah. Just purely believing the output without questioning is never appropriate. So we certainly run a lot of checks. So, like I mentioned in my presentation, if there are some unusual results, they serve as a red flag for further investigation. So it could be an error in the data, or perhaps there's a very valid reason. So you have to uncover which it is. So when the Delta factor system is updated on a regular basis, that there's a whole number of checks just to make sure that the mathematics behind it has been appropriately applied.
Thank you. So I've got one more question for David today, and that's in regards to, I guess, your presentation. A lot of it is about emotional buy-in from the client, but do clients ever look for a more quantitative validation to construct their portfolio with yourselves?
It's quite interesting. Benchmark analysis is terribly important for us. Report cards, if you will, on a monthly basis. We also give our clients access to their performance in virtually real time. I think the other thing, though, is that quite often we're dealing with the patriarch or matriarch of an ultra high net worth family group. Sometimes we're dealing with the CIO, the CFO, where that quantitative analysis is important, and we will share with them all the risk analytics that we can pull from our systems in regards to really trying to, drive the alpha and reduce the beta, so to speak. That is really important, and we'll talk to those terms. I think anything beyond that does tend to get probably into product range or product world.
Right.
If you were to look at the demographic who's looking for a bespoke constructed portfolio, they're probably looking to us to deep dive into analytics around ESG. So I think that's actually where we tend to pull out most of our guns regarding analytics, simply because, let's face it, most of the investors that we have were very successful in their own right, but it wasn't in funds management. That they're not fund managers. They're successful business owners who've had amazing liquidity events, or they're multi-generational family offices. So I would say that that's probably where it goes for us.
Thank you. All right.
So to all of the panelists, Michael, Stephen, David, and Nancy, particularly to you, and to those of you in the audience, this is Nancy's first time speaking to a mass audience like this. Thank you very much for your insights today. There were a couple of questions that came through about client reporting or mapping clients' financial goals. This series isn't really addressing those until we get to the Friday session, where client reporting really is one of the three things that we're going to focus on. But let me share with you the next webinar in this series on Wednesday. Two of the most established portfolio management organisations in Australia, Implemented Portfolios and Watershed. Both organisations have been running managed accounts in a variety of structures, on platform, off platform, MDAs, SMAs, for well over a decade, and in the case of both organisations, probably close to 15 years. So it'll be our pleasure with Nancy to talk on Wednesday about the tools they use for managing portfolios in a context where sometimes these are run as models and sometimes run as individually managed accounts. So thank you very much for joining us today, and we look forward to you joining us on Wednesday to talk with Chris King and Adrian Rowley. And then on Friday to deep dive into client reporting, risk management tools, and a 101 on performance measurement. Thanks very much for your time today. We look forward to you joining us again on Wednesday. Thanks.
Thank you.
Right.
All right.